So this video is to supplement the Eli and Peyton example that we began in class. I have the key up for you, but I wanted to go ahead and just walk through how I would journalize and how I would think about the UGRV scenario, and then also talk about the BPO scenario. So like I said in that supplemental information I uploaded over the weekend, the first step that I consider, of course, is I take an asset fair value, right? I look for that number. So this is the sale price of the asset that's being leased. Then I look for its cost. And then this is the cost to the lessor of the asset that's being leased. The next thing is you have to start getting dirty with the present value. You got to figure out what those MLPs are, because remember that MLP will determine whether or not we have a capital lease. Remember, if the present value of MLPs are greater than or equal to 90% of the leased assets fair value, we have a capital lease. So what you're going to be comparing then is whatever these MLPs are to the assets fair value. Now, we already know that this is capitalized because the lease term is for 9 years and the economic life of the asset is 10. However, it's always a good idea to practice so that you can make sure you would know this. If we didn't trigger because of the useful life rule, you could appeal to the 90% of the fair value of the assets rule. So let's go ahead and start working through this. What are the MLPs to the lessor? Now, the MLP to the lessor would be everything except a UGRV. Well, now we're at a UGRV, so the MLPs you calculated before aren't going to work, because before it was a GRV. The lessor is required to guarantee that residual value, and so they had a future value that they put into their account, into their present value calculation. However, now because we have a UGRV, we have nothing in our future value. So we have a $0 future value. The payments don't change with the UGRV. We're assuming the same payments in this case. I'll inform you on the test if I want you to change payments because of the UGRV. But in both cases, the lessor is expecting something, and so the UGRV would not change. So we have payments of $250,000. Now we look at the lease term, 9 years, and the interest rate that would be used by Eli. Remember, there's two rates here. There still will be two rates. Eli is going to use the 9% incremental borrowing rate, and that would give me a present value of a certain amount. So go ahead and calculate that. And then the present value of this would be, I thought I knew how to use this calculator that I found in class and that I claimed as my own, 1,633,705. That's what the MLPs are. Now, are the MLPs 90% of the leased assets fair value? Well, in order to determine that, we'd have to take this amount divided by the 2,1633705 divided by 2 million. Comes up to 82%. So it would not have passed by the 90% rule. But it does pass because of it does pass because of the 75% rule, because we have 9 years of a lease term and 10 years of an economic life. So that one passes, that one fails. And it's going to be very important that you're able to test all of those conditions, that you understand what you're applying here with this present value of MLPs and the 90% of the fair value of the leased asset rule. Okay, so make sure you understand that. So let's go ahead and start to record this for Eli. He's the lessee. We would have a leased asset for the amount of the MLPs. This is always going to be the case for the lessee. The leased asset, always the present value of the MLPs. The lease liability, if there is an initial payment, will be less than the leased asset by the amount of that initial payment. So in that case then, 1,633,705 less the $250,000. It would be $1,383,705. Now let's move to the lessor, Peyton. What is the present value of the lease contract to Peyton? Well, it's going to be very similar to what we did with the MLPs, except because it's a UGRV, Peyton does anticipate a future value, while my lessee did not. And so we're going to run the same calculation, except now we have a future value of $100,000. We have payments of $250 that are being made. We have an N of 9, and we have an I equal to 10%. And so this is going to be the same capitalization that Peyton applied to the GRV context, because they do actually record the capitalization of that future value even when it's a UGRV. And so in that case, Peyton recorded it at a present value of $1,626,141. So this is the present value of the contract to the lessor. This is the minimum lease payments. One of the questions I said is, when are those things different? Or when do you think they will be different? They will be different under at least two very particular scenarios: when there's a UGRV and when different rates are being used. So Peyton is going to record a lease receivable. If there was not an initial payment, the lease receivable would be equal to everything Peyton expects to get, which would be $1,626,141. But there's an initial cash payment. So we receive cash of $250,000, which decreases the amount of the receivable that I record to $1,376,141. So I have those two items recorded. The other item that's pretty easy to record is the inventory. We want to credit the inventory at the cost of the asset, always. Don't subtract anything off. Don't subtract ever anything off. Okay. Now, sales revenue. Sales revenue is interesting because it's going to reflect only those things that the lessee has guaranteed. And so what we would want to do, sometimes we could just take that, because that is what the lessee is guaranteeing. But remember, the lessee is guaranteeing that with a 9% assumption for a rate, whereas the lessor is using a 10% assumption. And so I do have to make a new calculation where I look at the present value of what the MLPs would be. That is a payment of $250,000. Because I'm thinking about the MLPs, the UGRV is no longer applicable. I still have a period of 9, but now I'm using an I of 10%. And so my calculation is just slightly different than what I had before because I have a future value that is 0 in this case, payments that are $250,000. I have an I that is 10%, and my N is 9. Which gives me a present value of, check to make sure that that's correct. $1,583,731. The only item I have left now is my COGS. My COGS would be the present value of the UGRV subtracted from the cost of the inventory, only because I have a UGRV. And so because I'm just looking for the present value of my COGS, I don't have any payments. I'm sorry, not the present value of my COGS, my present value of my UGRV. I don't have any payments. I do have a future value of $100,000. That's my UGRV. My N is 9 and my I is 10%. In that case, when you calculate the present value of the UGRV, it would come out to $42,410. That's the present value of my UGRV. I would subtract that from my COGS. So 1 million minus 42,410 gives me $957,590. That's the complete setup for this. Now, from here, for the end of year adjustments, you just have to look at a couple of items. So Eli would have interest expense that arises from the lease liability, 1383705. That amount multiplied by the 9% gives me the amount of interest expense that I would record, $124,533. That's also interest payable, assuming that this is made on 12/31, because I won't actually make the cash payment until the next year. My accumulated depreciation and my depreciation expense will change slightly because now I have a UGRV. The UGRV would indicate that Eli is going to take this asset, no salvage, because there's a UGRV. There's no BPO, there's no title transfer, so I'm going to want to break that up over the lease term. That gives me a depreciation of $181,523. So because there is no salvage, because I'm going to now depreciate the entire amount, it's a little bit higher than the depreciation expense that I had under a GRV. I look at Peyton, they have the UGRV. They wrote the asset off, so there's no depreciation expense that Peyton has to recognize. They will take the lease receivable because that's what they're earning their interest revenue off of, multiply it by the rate that they use to discount their cash flows. So they would record interest receivable of $137,614 and interest revenue of the same amount. Now notice that this is the same amount that they recorded under the GRV example. And once again, we should expect that because Peyton is still counting a future value when they use a UGRV. Okay, so the lease receivable would be at the same amount as it would have been under the GRV. So, kind of think about what's the same. This doesn't change, same as a GRV, because we still assume that $100,000 in the lease contract to the lessor. COGS changes because of the UGRV. We take out the present value of the UGRV. Inventory is the same as the GRV. Sales revenue is going to be different because now the lessee is not promising us the UGRV. And so we can't just assume that whatever they capitalize as a leased asset will still come to me as sales revenue. I have to determine the present value of the UGRV to back it out of cost of goods sold. I need to determine what I'm actually selling the lessee by showing that I'm not selling them any guaranteed residual value. There is an unguaranteed residual value, and so that number is 0. And because we are dealing with the lessor, everything is in the lessor's interest rates. All right? When we go to settle the lease, remember, whenever we go to settle the lease, and this is going to be an autofocus nightmare until it sees some text. When we go to settle the lease, we want to know, in order to determine the lease liability, we're looking at what the lease liability was at 1/1 at the final year. And this is true too of any lease receivable at 1/1 at the final year. So remember, payments are made at the beginning of the year, which reduces my lease liability or my lease receivable. Now, the question is, under a UGRV, does the lessee have anything that they need to actually calculate the present value for? Well, in this case, they don't, right? Remember, they don't have a future value. There are no payments remaining because we're at the final year. After we made that first payment, after we made that final payment, nothing more is being paid. N is 1, I is 9, but none of that matters because I have 2 zeros. This implies that there is no lease liability remaining. Now, the lease receivable at the final year. Remember, the lessor still assumes they're going to get something back with a $100,000 value. That is their future value. There are no payments left for them to receive because they were paid it at 1/1. N equals 1 because we're 1 year away at 1/1 to 12/31. And they're still using their 10% rate. And so the lessor, after they calculate that present value, which would be $90,909, this is the carrying value of the lease receivable after the final payment. Okay. Now, the carrying value of the lease receivable after the final payment, but it's not at $100,000. It hasn't earned the interest over a year to get up to its future value, which means that when the lessor finalizes this, they would have had interest receivable or interest revenue generated during the year. and they would need to get rid of the last piece of their lease receivable. In order to have this deal wiped off the books. What's the interest revenue? Well, again, it's just the carrying value times the rate of interest they use. Now, how do they get rid of this? Notice that this adds up to the $100,000 that I recognize as my future value, right? Because it starts off at a value, it generates interest revenue. That gives me the total $100,000 that I would end up at the end of the year. How are they going to get this back? Well, I said that the item had an $80,000 appraisal at the end of the lease contract. If it were a GRV, they would get cash as well. But since the lessee was not required to guarantee it, there is a $20,000 loss on lease. What's happening over here with the UGRV? I'm sorry, with the UGRV and the lessee. Well, I said there was no lease liability remaining, so I don't have to debit lease liability. I don't have any more interest expense that's generated. I do have an asset that I need to get off my books. And the way I would get it off my books is by crediting the leased asset by the historical cost, which was the MLPs that I paid and then the question is, well, how much accumulated depreciation did I apply? Since I had no salvage, nothing, no residual that I recorded here, I would have recorded all 1,633,705 as expense over those 9 years. So I would have accumulated depreciation of 1,633,705, and this completely wipes it off the books. Okay. So that's the UGRV, and that's what people typically have the most problems with. Now, with the BPO, will there be a difference between BPO treatment and GRV? So remember, the GRV was the first one we did. You should be able to answer this question. The best way to really see it is by looking at the present value of MLPs and the present value to the lessor. Now, what's it look like under the BPO? What does it look like under the GRV? What does it look like under the BPO, the GRV? So for the BPO, we would have a future value equal to what under the BPO? Now, for the present value of the MLPs, this is from the lessee standpoint, we assume they're going to take the bargain, right? So if that $100,000 is a bargain purchase option, they record it as a future value. The GRV, they have to guarantee. That is a future value to them as well. Let's look at the lessor. The lessor expects they're going to exercise that future bargain purchase option. They also have written into the contract a guarantee in the case of the guaranteed residual value. So we see equality there. The payments, they're going to be $250,000 in every case. The payments are always capitalized by everyone. Notice the only time I set the payments to 0 was to determine the present value of the UGRV, and that was it. N is 9, always, because that's the lease term. Remember, N is always equal to the lease term, never the economic life of the asset. The I is going to differentiate between lessor and lessee, but the I doesn't change from BPO to GRV for either party. And so if these items are all the same, that means that my present value will be the same under the BPO or the GRV to the lessee and the same to the lessor, which means there will be absolutely no difference in the recording of this lease between a BPO and a GRV for lessor or lessee. Now, what will change or could change? We are now qualifying because of Rule 2. We are still qualifying because of Rule number 3. So depreciation expense may be different. The other thing that will change is the end of term deal. Because it's a BPO rather than a GRV, the lessee does not need to credit the leased asset and debit interest expense. They instead are just going to pay cash. They would have a lease liability, and they would have some interest expense over the final year. And remember, in order to find the carrying value of that lease liability at 1/1 of final year, we would look for the present value. When the future value is 100, that's the BPO, N is equal to 1, and I is equal to 9%. That would be $91,743, just as it was in the GRV. We would have interest expense of $8,257, which again brings me up to my, at the end of the year, $100,000 value, and I would pay cash for $100,000. All right. And for the lessee, it would look much the same as we've seen before. Up here, they would have the same lease receivable because they're calculating the same present value. They'd have the same interest revenue, use the same amount to calculate interest revenue. The only difference would be instead of inventory and a loss on lease, they would take in a debit to cash. I didn't discuss this because I don't want you to worry about qualifying under 2 rules and what depreciation expense to take. You have enough details to worry about without thinking about that. And so I promise that on the test, my leases will only qualify because of 1 rule if they qualify. All right. So that's how you work the alterations to the UGRV and the BPO. And again, I want you to really start thinking about these concepts where, would there be a difference between a BPO and a GRV? Well, no, because everyone uses the same inputs to their present value calculations. The only thing that could come up is that a BPO triggers qualification because of rule number 2. And so it might mean something different to the amount of depreciation expense. But other than that, the only other thing that changes is an end of term deal where I'm giving up cash instead of, as the lessee, instead of turning over a leased asset with a $100,000 book value, right? And so you need to start figuring out that these present value calculations really drive everything that's going on in these problems. And again, start out with this idea that, well, I need to find the fair value of the asset. I need to know what its cost to the lessor was. And then I'm going to look at two present value calculations. I'm going to look at the present value of the MLP. And unless there's a UGRV, the present value of the MLPs will be the same as the present value to the lessor as long as the interest rates are the same. Look at what changes values. Look at what the lessee reports, but the lessor won't report. Once you see the differences between the two, you can start making some patterns. It'll make your life a lot easier. All right. So if you have any questions about these, of course, bring them up in class. We have one more day to dedicate to leases, thank goodness, because I think we need it in order to really shore up your understanding of what's going on here. Thank you.